When people talk about property investment as a better alternative to renting, they often focus on a few key advantages that home ownership or property investment can offer. While renting does have its benefits, such as flexibility and no maintenance or responsibilities, owning a property is frequently considered a far wiser, longer-term choice for financial growth. Let's break down why the property investment can be advantageous. Firstly, you get to build up equity over time. One of the primary benefits of property investment is the ability to build equity. Equity is essentially the difference between what you owe on a mortgage and the value of the property. As you pay down the property, and ideally the property's value appreciates, you accumulate wealth in the form of equity. This contrasts with renting, where your monthly payments go directly to the landlord without any future financial benefit. Property investment allows your money to work for you while turning an essential need, which is housing, into a financial asset. For example, in my case, the property I bought for £23,000 increased in value to £90,000 by the time we sold it. Had I been renting instead, all of those payments would have simply disappeared without contributing to any financial gain. There's also the potential for you to make money from rental income. When you invest in a property, especially if you buy to let, there's an opportunity to generate rental income. While you're living in the property, you can rent it out. You can rent out the spare rooms, which is what I did during university. Or if you choose not to live there, you can rent the entire property. This additional income stream can help cover your mortgage and provide extra cash flow. Over time, the rental income may even surpass your mortgage payments, creating a steady profit. Renting, on the other hand, provides no opportunity for passive income. Instead, you're essentially paying off someone else's mortgage. There's also the advantage of long-term appreciation. Historically, property values tend to rise over time. Even if there are dips in the short term, this makes real estate generally a sound long-term investment. In the UK, property prices have grown steadily, especially in urban areas. This means that if you hold on to a property for several years, there's a strong chance that it will be worth significantly more than what you originally paid for it. In my own experience, my side property's value surged due to the improvements I made and a boom in the local property market. This kind of growth is simply not something you can benefit from while renting. Leverage is another key aspect of the property world. Property investment also allows you to leverage your capital. When buying a property, you can put down a smaller percentage of the total price, which is about 10%, and borrow the rest from the bank in the form of a mortgage. This allows you to control a large asset with relatively little capital up front. When the property increases in value, your returns are based on the full amount of the asset, not just the amount of your deposit. In contrast, renting doesn't allow you to leverage money in the same way. The monthly payments you make do not provide you with an asset or allow you to benefit from any increases in the property value. There's also the issue of stability and control. Owning a property gives you more control over your living situation. You can make changes to the property as you see fit, whether that's renovating, decorating, or even expanding. You're not subject to the whims of a landlord who could raise the rent or decide not to renew your lease. The sense of control also extends to property investors who decide to rent out their homes. You can set the price terms on the lease, this rent price, and the decisions about maintenance and improvements. With renting, you're more restricted by the conditions set out by the property owner. There are also tax benefits and government incentives. For property investors, there can be certain tax benefits such as deduction for mortgage interest, maintenance cost, and property management fees. Additionally, governments often have schemes to support first-time buyers or property investors. For example, in the UK, there are programs like Help to Buy or shared ownership that make property investment more accessible. From the renting perspective, it's worth noting, however, that renting does have advantages. It does provide flexibility, which can be ideal for people who move frequently or for those who prefer to handle the responsibilities of property ownership. Renting also eliminates the risk associated with the property market downturns, maintenance cost, or large upfront capital requirements like a deposit. But in the long term, renting often means missing out on wealth accumulation through property appreciation and equity growth. In summary, property investment can offer long-term financial benefits through equity, rental income, and property value appreciation, while also giving you control over the living situation. Renters, on the other hand, enjoy flexibility and lower short-term commitment, but often miss out on those financial rewards. The understanding became clearer to me when I realised that buying a property for £23,000 not only gave me a place to live, but allowed me to benefit financially from renting rooms out and the long-term appreciation in value. What began as a necessary purchase became an accidental investment success. When I was in the second year of my university, I stumbled upon a property at the edge of Moss Side in Manchester that was for sale for £23,000. It wasn't in great condition. There were no carpets, the electrics and gas systems needed updating, and it was infested with slugs. It was, to say the very least, far from move-in ready. At the time I had no knowledge of property investment, particularly the buy, refurbish, refinance or BRR strategy. But this property was a classic example of that model, even though I didn't realise it then. A relative who owned a local restaurant recommended a builder to help with the renovations. The builder managed to do most of the work but didn't complete everything, but this is how you learn. It was a basic 2-up, 2-down property, but once it became livable, I moved in and rented out the other 2 rooms to friends. I charged £35 per week, which is slightly less than what my friends were paying elsewhere, and I was able to keep the rent money. I believe my parents trusted that I wouldn't waste it. One of my friends, however, moved out shortly after, citing fears about the area, despite never having had a bad experience there. For me, this was part of the learning curve of being a landlord in an area that didn't have the best reputation. In my third year, I followed a similar plan. I rented one room out to a couple and the other to a friend. Once again, the couple didn't stay long, complaining about the area and even mentioning hearing ghost noises. Still, the rent helped cover my costs during the second and third years of university. By my fourth year, I moved into student halls as I wanted to experience halls again and rented the property out through an agency. The property was fully tenanted during this period and things seemed to be going well. After graduating, I moved back home. This is where things took a bit of a turn. My parents and I weren't familiar with the concept of remortgaging or pulling out equity, so they decided to sell the property. The property had been bought in the year 2000 for £23,000 and was sold in 2005 for £90,000. We were incredibly fortunate, as not only had we added value through renovation, but the area also experienced a significant boom during that time. It turned out to be the best BRR project I've ever done, and it was all done completely by accident. In hindsight, the only mistake was deciding to sell it. This decision stemmed from another misunderstanding. We noticed on the statements from the agency managing the property that they were charging us 16% management fees instead of 11% as we expected, but we wrongly assumed that they were overcharging us. What we hadn't factored in were the maintenance costs, VAT and other additional fees. As a result, we thought it would be better to manage future properties ourselves and began looking for something closer to home in Coventry. We reasoned that if we self-managed, we could cut out the agency fees. However, I've since learnt that this was not the best idea. In property, time is often more valuable than money. Having a fully managed property allows you to focus on other opportunities rather than getting caught up in the day-to-day management of existing assets. The early experience was an invaluable lesson. While luck played a huge part in this success, I also learnt the importance of understanding the market, the value of time, and needing to fully assess the costs associated with property management.